Hi, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, the stock market decided to go positive today despite a slide in the iron ore price. So let's see how professional fund managers view today's action and how David Buckland from Montgomery Investment Asset Management is going to be looking at the market going ahead. We'll see whether CMC's Michael McCarthy is revising his views on Fortescue, or is he becoming an even bigger buyer as the shorts take aim at the stock. We'll see if the economist Saul Eslake is right when he suggests that the RBA would have to be insane to cut rates next week, given the house price rise in Sydney. We'll check this one out with property watching expert Louis Christopher. And believe it or not, but there is something called a banking and finance oath. But does the industry take it seriously? St James Centre's Executive Director, Simon Longstaff, thinks it's a really good idea, but does the industry agree with him? Stay with us for the next hour, and we'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to switzer@switzer.com.au. You can follow me on Twitter, and the handle is @PeterSwitzer. Now, I want to start off by praising the Abbott government for taking on the big issues. However, what's going on in Canberra reminds me of a Seinfeld joke. There's a lot of relevance to what Tony, Joe and the rest of the team are getting so wrong at the moment. The US comedian Jerry Seinfeld once revealed that geneticists reckon that men are biologically programmed to want to do big things, such as build tall buildings, highways, bridges, etc. But why don't men do these things? Well, as Jerry points out, they're really, really hard. Joe and Tony, let's even throw in Christopher Pine, the self-confessed fixer, are all shooting for commendable big thing goals. The Commission of Audit before last year's budget, the Harper Review into competition, and now the taxpayer, a paper that recommends changes to the GST and has led Joe and Labor to start talking about working together to change super tax concessions. These are all really big things. This is all very noble, but it borders on the crazy for a government that's as popular as Asada and this is an AFL home game. The only guy showing any political nous was the PM this week, who virtually said, on a coalition Labor crackdown on super retirees, well, that's not going to happen. Yesterday's big story was that there are 76,000 retirees who collectively get $10 billion a year in tax concessions. Some 24,000 have super balances over $2 million, while 52,000 have between $1 to $2 million in their super funds. Being in the tax-free zone because of age or retirement means Treasury loses potentially taxable money. With a 15% tax, community groups say about $300 million a year would be collected to help lower income Aussies. Labor doesn't mind hitting most of these retirees because most of them wouldn't vote Labor, if only for fear of losing income. On the flip side, there are about 76,000 voters Tony Abbott definitely can't afford to lose. So why would Joe be willing to have a conversation about these people ahead of the budget? The same fear-creating issues turned up last year before the budget and spooked a lot of listeners at radio station 2GB in Sydney, where I do the Super Show on Monday night. The fear continued to build over the budget process, with students, the unemployed, families and pensioners all feeling the pinch of an economically responsible treasurer who ignored that his economy was slowing. He also miscalculated a negative, scary budget dressed up with a whole lot of doomsday stuff about debt was never going to get consumers to spend and businesses to invest. Our economy is growing in the 2% band. Even a student in Macroeconomics 101 knows unemployment should rise with such low growth. Retirees spending lots of money on cars and holidays and fancy food and helping small businesses create profit shouldn't be frightened into sitting onto their wallets. The main job of a treasurer who wants to get re-elected and see his boss not get replaced by Malcolm Turnbull is to get confidence up and get this economy growing. The treasurer should be talking about the great things that will get done once we have an economy creating jobs. For now, the main job is to create jobs. Keep it simple and remember, it is the economy, stupid. Nothing else matters to anyone wanting to stay employed. Keep a business alive, pay the bills and get ahead. Tony's now got it. But it's time he took his team by the scruff of their necks and told them, get real. Once that happens, the Abbott government will get popular, and then really big, hard things will be doable by the real men that Seinfeld cracks jokes about. Okay, the stock market turned positive today, but it seems to be a day-to-day proposition, and there doesn't seem to be anything really driving the market either way. So how is a professional fund manager such as David Buckland of Montgomery Investment Management playing this market? What stocks look like they're good value and which ones don't? And how much cash is in his fund? David joins us from our Sydney studio. David, thanks for joining us.
Happy Easter, Peter.
Same to you, mate. So how are you viewing the market at the moment?
We think it's a little on the expensive side, Peter. We've been building our cash up just very marginally over the last month. We're buying very selectively, but in overall terms, we're being quite discerning.
Okay, how much cash are you holding?
Across our two funds, we're holding close to 30 percentage points.
Okay, is that high for you guys?
Probably on the higher side of average, Peter, that's right.
Okay, so therefore, what's going to change the equation for you to look at this market and say, oh, it's no longer expensive? Do you need to have a correction at least?
You either need two things. One is a correction, or the second thing is that earnings grow much higher than anticipated. So just to give some context to our viewers, Peter, back sub 3 years ago, the market was 4,000 points. Now it's approaching 6,000 points. That 2,000 point increase has been largely driven by lower interest rates. Probably only a small percentage of that 50% increase has been driven by earnings growth. So what we've seen is a large re-rating of the market without the earnings really coming through. So we're either looking for two things, as I say, a pullback in the market or stronger earnings growth than anticipated. Now that's definitely happening, but in very, very thin pockets of the market.
Okay, what if rates are cut on Tuesday? Does that change the equation in any shape or form?
Not in any significant way. You know, rate cuts are a temporary phenomenon, and obviously all it does is it increases the chase for yield. But again, it's not permanent, it's temporary only.
Okay, what about your view on earnings? Are earnings very closely related to the strength of the economy? I know last week I interviewed at least 3 CEOs when I asked them what they really wanted to see. Did they want to see a responsible budget, or do they want to see confident consumers? They all said confident consumers. So is the economy critically important to get overall earnings up?
Well, yes. I mean, there's obviously pockets of the economy that are highly related to China, and domestic confidence has no influence whatsoever on that. There's also pockets of the economy, such as the banking sector, that are quite related to net margins and the like. But in overall terms, stronger economies see earnings improve, which in turn see markets generally do better than not.
Okay, you said earlier that there are certain pockets of the market where you're seeing some value. Can you give us an idea of a typical company that you think looks like it's defying the general expectation you have about the market?
Yes, so one stock that we've liked since last June is a company called Isentia. ISD is the ASX code. It floated at $2.04, and it's just come out with a really, really excellent half-yearly report to December. On the back of that half-yearly report, we added to our holding. We already owned it during the IPO, and we added a bit more soon after the IPO last June, and it's now trading at about $3.60. So that's a stock that really did surprise on the upside in terms of its earnings. Now, another stock, conversely, that hasn't really reported excellent numbers yet, but we think could do much better than anticipated, is the old demerged business from the AMP called Henderson's. Henderson's, as you know, Peter, is a UK-listed fund manager, but what's happening is the UK and Europe are benefiting from two things. Firstly, a number of QE stimuli, and secondly, a very, very strongly falling euro. So what we saw in the March quarter, for example, is the French, Italian and German markets all up about 20 percentage points. And Henderson's, we think, will benefit quite a lot from that. So that's a stock that we think could have, is selling at approximately 20% discount to our assessment of its intrinsic value, with a pretty strong tailwind behind it.
Is it a good way for a local to play the European stock market without actually exposing yourself directly to a European company?
Oh, I think so. You know, it is listed on the ASX, so a local can certainly buy it very easily. HGG is its ASX code, and as I say, it's obviously going to benefit from both Europe and the United Kingdom, and flows into its fund, which were obviously out very dramatically during the GFC, and I think that'll reverse quite considerably in the foreseeable future.
Can we go back to Isentia? What does this business do? Explain to my viewers.
Okay, so this is a corporate monitor business. It's merged with another organisation about 14 months ago. It's got very strong market share in Australia. So to give a simple example, Coca-Cola might pay Isentia $500,000, and Isentia would drop digitally every bit of information on Coca-Cola Amatil that's taken place in recent minutes, hours, or sort of days onto the sort of the marketing, branding, and communication department within Coca-Cola Amatil. Now, this is very important for companies that might be going through, for example, some sort of anxiety. So, for example, if Qantas had a plane crash in, for example, Bangkok, they want to know absolutely everything that's going out, both in Bangkok terms and also social media terms. And Isentia are picking that information up and sending it straight through, collecting it all, and so the marketing people, the branding people, the communication people are all over the information, and in the scheme of things, they don't pay a lot of money for that information.
Yeah. I would say Alan Joyce and Olivia Worth would have preferred you to select a different example, David, but I think you did make the point very well. Is it the old media monitors business?
It is. In fact, the founder's father was part of a media monitor organisation back in the mid-1970s.
Yeah, that's right. It wasn't Ian Parry Oakton, was it?
No, the founder is named John Kroll, but his father was also involved in that business.
Yeah, I knew there was an old radio name behind that. Now, I guess the interesting question is, how do you actually make a judgment call that this company is going to do well? What kind of external and internal things do you need to see for you to change your expected valuation on the company?
So in this case, Peter, what we've seen is it has a very strong positioning in Asia, and it seems to us that over the medium to longer term, the Asian operation could be neatly bigger than the domestic operation. Domestically, they have enormous market share. We think something like 90 percentage points of the Australian and New Zealand market, and that's growing at GDP plus about 5 percentage points per annum. So it's a very solid cash flow business that's producing enough cash flow for them to expand very dramatically in the Asian region. And as we know, the middle class in Asia is growing dramatically, both in magnitude but also in population. So here's a business we think, on a 5 or 8 year view, could be, incredibly valuable. But what was most important to us was the half-yearly results were, in our opinion, the commentary around them was neatly better than what we'd anticipated. So for us, that was what we would classify as an upside surprise.
Okay, so it's $3.60 or thereabouts. What value have you placed on the company? Because you always look at what the market value is and what you think it's worth. What kind of value are you putting on it?
Well, we think it's worth probably closer to $4, and we as I said, it floated at $2.04 back in June last year. We added to it significantly over a period of months, and then when we saw the half yearly, it was still selling at around between $3 and about $3.15, and we jumped on it quite quickly after we analysed the half yearly report.
Yeah, okay. Looking at the chart, there's been a pretty steep rise. Would your expectation be it'll probably level out around these levels before it proves to the market again that it is actually reproducing the last half year's result again in this half? Oh,
of course. When a company goes more or less like a J-curve, it needs to mark time for a period of time. It may not surprise in the preliminary final statement in August. It may take till February next year or even August 2016. But we're not obsessed about that. We're obsessed about buying really high quality businesses that can do well over 3 to 5 years.
Just one last one before we go. I know you guys used to like Green Cross. I think it got clobbered this week. Do you still analyse the company? You still have a view on it?
Look, we did exit that when it got too expensive for us, Peter, and we stated that we exited that, and we've sort of just taken our eye off of that one because we've got our eye more, as I say, on things like Henderson's, Medibank Private's come back a bit. We're having a good look at that, and Challenger is another one that we like for the very, very long term.
All right, mate, thanks for joining us. Have a great Easter.
Same with you, Peter. Thanks for your time.
That's David Buckland from Montgomery Investment Management. After the break, we'll survey another pro to see how this market is affecting the way he invests.